Hello everyone, and thanks for watching Edupedia World videos. In this chapter, we are going to analyze money and financial system. For that, we are going to define money and present the functions of money. Then, we are going to talk about the financial system, the banking system, liabilities and assets, and by the end, we are going to focus on the central bank and its main functions. So let's get started. Before going any further, we must define precisely what we mean by money. Not as easy as task as it sounds. Money is more than just notes and coin. In fact, the main component of a country's money supply is not cash, but deposits in banks and other financial institutions. Only a very small proportion of these deposits is kept by the banks in their safes or tills in the form of cash. The bulk of the deposits appear merely as bookkeeping entries in the bank's accounts. This may sound very worrying. Will a bank have enough cash to meet its customers' demands? The answer in the vast majority of cases is yes. Only a small fraction of the bank's total deposits will be withdrawn at any one time, and banks always seek to ensure that they have the ability to meet their customers' demands. The chances of banks running out of cash are very low indeed. The only circumstance where this could become possible is if people lost confidence in a bank and started to withdraw money in what is known as a run on the bank. This happened with the Northern Rock Bank in 2008, but in these circumstances, the central bank or government would intervene to protect people's deposits by making more cash available to the bank, or in the last resort, by nationalizing the bank, as happened with Northern Rock. What is more, the bulk of all but very small transactions are not conducted in cash at all. By the use of checks, credit cards, and debit cards, most money is simply transferred from the purchaser's to the seller's bank account without the need for first withdrawing it in cash. What items should be included in the definition of money? To answer this, we need to identify the functions of money. The main purpose of money is for buying and selling goods, services, and assets. That is, as a medium of exchange, as you can see. It also has three other important functions. Let's examine each in turn. The first function is related to the fact that money is a medium of exchange. In a subsistence economy where individuals make their own clothes, grow their own food, provide their own entertainments, etc., people do not need money. If people want to exchange any goods, they will do so by barter. In other words, they will do swaps with other people. The complexities of a modern developed economy, however, make barter totally impractical for most purposes. What is necessary is a medium of exchange that is generally accepted as a means of payment for goods and services and as a means of payment for labor and other factored services. Money is any such medium. To be a suitable physical means of exchange, money must be light enough to carry around, must come in a number of denominations, large and small, and must not be easy to forge. Alternatively, money must be in a form that enables it to be transferred indirectly through some acceptable mechanism. For example, money in the form of bookkeeping entries in bank accounts can be transferred from one account to another by the use of such mechanisms as debit cards and direct debits. Money is also a means of storing wealth. People need a means whereby the fruits of today's labor can be used to purchase goods and services in the future. People need to be able to store their wealth. They want a means of savings. Money is one such medium in which to hold wealth. It can be saved. The third function is called a means of evaluation. Money allows the value of goods, services, or assets to be compared. The value of goods is expressed in terms of prices, and prices are expressed in money terms. Money also allows dissimilar things, such as a person's wealth or a company's assets, to be added up. Similarly, a country's gross domestic product, the GDP, is expressed in money terms. Money thus serves as a unit of account. Eventually, it's a means of establishing the value of future claims and payments. How's that? People often want to agree today the price of some future payment. For example, workers and managers will want to agree the wage rate for the coming year. Firms will want to sign contracts with their suppliers specifying the price of raw materials and other supplies. Money prices are the most convenient means of measuring future claims. What should count as money? What items, then, should be included in the definition of money? Unfortunately, there is no sharp borderline between money and non-money. Cash, notes and coin, obviously counts as money. It readily meets all the functions of money. Goods, fridges, cars and cabbages, for example, do not account as money. But what about various financial assets such as bank accounts, building society accounts, and stocks and shares? Do they account as money? The answer is, it depends on how narrowly money is defined. The narrowest definition of money includes just cash, that is to say, notes and coin. Broader definitions include various types of bank account, and broader definitions still include various financial assets as well. In order to understand the significance of different measures of the money supply and the ways in which money supply can be controlled, it is first necessary to look at the various types of account in which money can be held and at the various financial institutions involved. That's why we are going to analyze the financial system. Let's see together the role of the financial sector. Well, banks and other financial institutions are known as financial intermediaries. They provide a link between those who wish to lend and those who wish to borrow. In other words, they act as the mechanism whereby the supply of funds is matched to the demand for funds. In this process, they provide 5 important services. 1. Expert advice. Financial intermediaries can advise their customers on financial matters, the best way of investing their funds, and on alternative ways of obtaining finance. This should help to encourage the flow of savings and the efficient use of them. 2. Expertise in channeling funds. Financial intermediaries have the special knowledge to be able to channel funds to those areas that yield the highest return. They also have the expertise to assess risks and to refuse loans for projects considered too risky or to charge a risk premium to others. Financial intermediaries also help to ensure that projects that are potentially profitable will be able to obtain finance. They help to increase allocative efficiency. 3. Maturity transformation. Many people and firms want to borrow money for long periods of time. And yet, many depositors want to be able to withdraw their deposits on demand or at short notice. If people had to rely on borrowing directly from other people, there would be a problem here. The lenders would not be prepared to lend for a long enough period. If you had 100,000 euros of savings, would you be prepared to lend it to a friend to buy a house if the friend was going to take 25 years to pay it back? Even if there was no risk whatsoever of your friend defaulting, most people would be totally unwilling to tie up their savings for so long. This is where a bank or building society comes in. It borrows money from a vast number of small savers who are able to withdraw their money on demand or at short notice. It then lends the money to house purchasers for a long period of time by granting mortgages, which are typically paid back over 20 to 30 years. This process, whereby financial intermediaries lend for longer periods of time than they borrow, is known as maturity transformation. They are able to do this because with a large number of depositors, it is highly unlikely that they would all want to withdraw their deposits at the same time. On any one day, although some people will be withdrawing money, others will be making new deposits. This does not mean that maturity transformation is without risks for financial institutions. Maturity transformation implies a maturity mismatch between the liabilities and assets on institutions' balance sheets. This needs managing, but as the financial crisis of 2007-2008 illustrated, this was often done badly. The fourth point is related to risk transformation. Indeed, you may be unwilling to lend money directly to another person in case he or she does not pay up. You are unwilling to take the risk. Financial intermediaries, however, by lending to large numbers of people, are willing to risk the odd case of default. They can absorb the loss because of the interest they earn on all the other loans. This spreading of risks is known as risk transformation. Finally, the fifth point is related to the transmission of funds. In addition to channeling funds from depositors to borrowers, certain financial institutions have another important function. This is to provide a means of transmitting payments. Thus, by the use of debit cards, credit cards, internet and telephone banking, checks, direct debits, etc., money can be transferred from one person to or institution to another without having to rely on cash. Now, let's move to talk about the banking system. And let's focus on the different types of bank. By far the largest element of money supply is bank deposits. It is not surprising then that banks play an absolutely crucial role in the monetary system. Banking can be divided into two main types, retail banking and wholesale banking. Most banks today conduct both types of business and are thus known as universal banks. Retail banking is the business conducted by the familiar high street banks such as Barclays, Lloyds, TSB, HSBC Royal Bank of Scotland, and NatWest, part of the RBS Group. They operate bank accounts for individuals and businesses, attracting deposits and granting loans at published rates of interest. The other major type of banking is wholesale banking. This involves receiving large deposits from and making large loans to companies or other banks and financial institutions. These are known as wholesale deposits and loans. As far as companies are concerned, they may be for short periods of time to account for the non-matching of the firm's payments and receipts from its business, or they may be for longer periods of time for various investment purposes. As these wholesale deposits and loans are very large sums of money, banks compete against each other for them and negotiate individual terms with the firm to suit the firm's particular requirements. In the past, there were many independent wholesale banks, known as investment banks. These included famous names such as Morgan Stanley, Rothschilds, S&G Hambros, and Goldman Sachs. With the worldwide financial crisis of the late 2000s, however, most of the independent investment banks merged with the universal banks. The rise of universal banks has provoked debate. In the United Kingdom, the Independent Commission for Banking set up by the coalition government to investigate the structure of the banking system proposed functional separation. The ring fencing of retail and wholesale banking. The argument here was that the supply of vital retail banking activities needed isolating from the potential contagion. Building societies. These United Kingdom institutions specialize in granting loans, mortgages for house purchase. They compete for the savings of the general public through a network of high street branches. In recent years, many of the building societies have converted to banks, including all the really large building societies except the nationwide. In the past, there was a clear distinction between banks and building societies. Today, however, they have become much more similar, with building societies now offering current account facilities and cash machines, and retail banks granting mortgages. As with the merging of retail and wholesale banks, this is all part of a trend away from the narrow specialization of the past and towards the offering of a wider and wider range of services. This has been helped by a process of financial deregulation, as you can see. In fact, banks and building societies are both examples of what are called monetary financial institutions, the MFIs. This term is used to describe all deposit-taking institutions. Banks and building societies also lend and borrow wholesale funds to and from each other. They also deposit with and borrow from the Bank of England. There has been a marked growth in wholesale funding. In many countries like the United Kingdom, this has contributed to the growth in the size of banks' balance sheets. Wholesale funds can be distributed amongst banks by means of a series of financial instruments. These instruments are typically short-term and acquired in markets known as money markets. During the financial crisis of 2008-2009, many forms of interbank lending virtually dried up. Banks and building societies became increasingly fearful of the other banks and building societies defaulting on loans. In response to the crisis, the Bank of England supplied extra money to MFIs to ensure the security of these institutions and the stability of the financial system. It did this by purchasing various assets from them with money it had, in effect, created. Now, let's talk about deposit taking and lending. Banks are in the business of deposit taking and lending. To understand this, we must distinguish between banks' liabilities and assets. Liabilities: customers, deposits in banks, and other deposit-taking institutions, such as building societies, are liabilities to these institutions. This means simply that the customers have the claim on these deposits, and thus the institutions are liable to meet the claims. There are four major types of deposit: sight deposits, time deposits, certificates of deposits, the famous CDs, and repos. Sight deposits are any deposits that can be withdrawn on demand by the depositor without penalty. In the past, sight accounts did not pay interest. Today, however, there are many sight accounts that do. In fact, there is quite aggressive competition nowadays between banks to offer apparently very attractive interest rates on such accounts, although these are often on balances up to a relatively small amount. The most familiar form of sight deposits are current accounts at banks. Depositors are issued with checkbooks and/or debit cards, for example, Visa, Delta, or Maestro, that enable them to spend the money directly without first having to go to and draw the money out in cash. In the case of debit card, the person's account is electronically debited when the purchase is made and the card is swiped across the machine and the PIN entered. This process is known as electronic funds transfer at point of sale. An important feature of a current account is that banks often allow customers to be overdrawn. That is, they can draw on their account and make payments to other people in excess of the amount of money they have deposited. Time deposits require notice of withdrawal. However, they normally pay a higher rate of interest than sight accounts. With some types of account, a depositor can withdraw a certain amount of money on demand, but there will be a penalty of so many days lost interest. They are not checkbook or debit card accounts, although some allow customers to use cash cards. The most familiar form of time deposits are the deposit and savings accounts in banks and the various savings accounts in building societies. No overdraft facilities exist with time deposits. A substantial proportion of time deposits are from the banking sector. Interbank lending has grown over the years as money markets have become deregulated and as deposits are moved from one currency to another to take advantage of different rates of interest between different countries. A large proportion of overseas deposits are from foreign banks. Certificates of deposits are certificates issued by banks to customers, usually firms, for large deposits of a fixed term. For example, 100,000 euros for 18 months. They can be sold by one customer to another, and thus provide a means whereby the holders can get money quickly if they need it without the banks that have issued the CDs having to supply the money. This makes them relatively liquid to the depositor but illiquid to the bank. We examine this below. The use of CDs has grown rapidly in recent years. Their use by firms has meant that, at a wholesale level, sight accounts have become less popular. Sale and repurchase agreements or repos. If banks banks have a temporary shortage of funds. They can sell some of their financial assets to other banks or to the central bank, the Bank of England in the United Kingdom and the European Central Bank in the Eurozone, and later repurchase them on some agreed date, typically a fortnight later. These sale and repurchase agreements, repos, are in effect a form of loan, the bank borrowing for a period of time using some of its financial assets as the security for the loan. One of the major assets to use in this way is government bonds, normally called gilt-edged securities, or simply gilts. Sale and repurchase agreements involving gilts are known as gilt repos. Gilt repos plays a vital role in the operation of monetary policy. Capital and other funds. This consists largely on the share capital in banks. Since shareholders cannot take their money out of banks, it provides a source of funding to meet sudden increases in withdrawals from depositors and to cover bad debts. It is vital that banks have sufficient capital. What about liability assets? A bank's financial assets are its claims on others. There are three main categories of assets: cash and reserve balances in the central bank, Bank of England in the UK and ECB in the Eurozone. Banks need to hold a certain amount of their assets as cash. This is largely used to meet the day-to-day demands of customers. They also keep reserve balances in the central bank. In the United Kingdom, these earn interest at the Bank of England's repos rate, or bank's rate as it is called. It kept within an agreement target range. These are like the bank's own current accounts and are used for clearing purposes, that is to say, for settling the day-to-day payments between banks. They can be withdrawn in cash on demand. With interbank lending being seen as too risky during the crisis of the late 2000s, many banks resorted to depositing surplus cash in the Bank of England, even though bank rate was lower than the LIBOR. In the United Kingdom, banks and building societies are also required to deposit a small fraction of their assets as cash ratio deposits with the Bank of England. These cannot be drawn on demand and earn no interest. What about short-term loans? These are in the form of market loans, bills of exchange or reserve repos. The market for these various types of loan is known as the money market. Market loans are made primarily to other financial institutions. This interbank lending consists of money lent at call, money lent for periods up to 1 year, but typically a few weeks, and certificates of deposit made in other banks or building societies. Bills of exchange are loans either to companies, commercial bills, or to the government treasury bills. These are in effect an IOU with the company issuing them, or the government promising to pay the holder a specific sum of a particular date, typically 3 months later. Since bills do not pay interest, they are sold below their face value, that is, at a discount, but redeemed on maturity at the face value. This enables the purchaser, in this case the bank, to earn a return. The market for new or existing bills is therefore known as the discount market. The price paid for bills will depend on demand and supply. For example, the more treasury bills that are offered for sale, That is to say, the higher the supply, the lower will be their equilibrium price, and hence the higher will be their rate of return or rate of discount. Normally, a bank will buy commercial bills only if they have been first accepted by another financial institution, typically an investment bank. This means that the investment bank will redeem the bill on the maturity date if the firm issuing the bill defaults on payment. Of course, the investment bank charges for this insurance or underwriting. Bills that have been accepted in this way are known as bank bills. Reserve repos. When a sale and repurchase agreement is made, the financial institution purchasing the assets, for example gilts, is in effect giving a short-term loan. The other party agrees to buy back the assets, that is to say, pay back the loan on a set date. The assets temporarily held by the bank making the loan are known as reserve repos. Reserve repos are typically for 1 week, but can be for as little as overnight or as long as 1 year. Long-term loans. These consist primarily of loans to customers, both personal customers and businesses. These loans, also known as advances, are of 4 main types. Fixed terms, repayable in installments over a set number of years, typically 6 months to 5 years. Overdrafts, often for an unspecific term. Outstanding balances on credit cards, amounts, accounts, and mortgages, typically for 25 years. Banks also make investments. These are partly in government bonds, which are effectively loans to the government. The government sells bonds, which then pay a fixed sum each year as interest. Once issued, they can then be bought and sold on the stock exchange. Banks are normally only prepared to buy bonds that have less than 5 years to maturity, the date when the government redeems the bonds. Banks also invest in various subsidiary financial institutions and in building society. Now, let's focus on the central bank, which is the last point. The Bank of England is the United Kingdom's central bank. The European Central Bank is the central bank for the countries using the euro. The Federal Reserve Bank of America, the Fed, is the USA's central bank. All countries with their own currency have a central bank, and the central banks fulfill 2 vital roles in the economy. The first is to oversee the whole monetary system and ensure that banks and other financial institutions operate, ensure as stably and as efficiently as possible. The second is to act as the government's agent, both as its banker and in carrying out monetary policy. The Bank of England traditionally worked in very close liaison with the Treasury, and there used to be regular meetings between the governor of the Bank of England and the Chancellor of the Exchequer. Although the bank may have disagreed with Treasury policy, it always carried it out. With the election of the Labour government in 1997, however, the Bank of England was given independence to decide the course of monetary policy. In particular, this meant that the Bank of England and not the government would now decide interest rates. Another example of an independent central bank is the European Central Bank, which operates the monetary policy for the Eurozone countries. Similarly, the Fed is independent of both the President and Congress, and its chairman is generally regarded as having great power in determining the country's economic policy. Although the degree of independence of central banks from government varies considerably around the world, there has been a general move in recent years to make central banks more independent. In the UK, if the UK were to adopt the euro, there would be a much reduced role for the Bank of England. At present, however, within its two broad roles, it has a number of different functions. Although, we will consider the case of the Bank of England, the same principles apply to other central banks. It issues notes. The Bank of England is the sole issuer of banknotes in England and Wales. The issue of notes is done through the issue department, which organizes their printing. This is one of the two departments of the Bank of England. The other is the banking department, through which it deals with banks. The balance sheet of the issue department shows the outstanding value of the banknote issue and the assets that back this issue. The ways and means advances on the balance sheet of the issue department represent the UK central government's overdraft facility at the bank. It acts as a bank to the government. It keeps the two major government accounts, the Exchequer and the National Loans Fund. Taxation and government spending pass through the Exchequer. Government borrowing and lending pass through the National Loans Fund. The government tends to keep its deposits in the Bank of England, the public deposits item in the balance sheet, to a minimum. If the deposits begin to build up from taxation, the government will probably spend them on paying back government debt. If, on the other hand, it runs short of money, it will simply borrow more. It acts as a bank. Big banks' deposits in the Bank of England consist of reserve balances and cash ratio deposits. As we have seen, the reserve balances are used for clearing purposes between the banks and to provide them with a source of liquidity. Prior to the financial crisis, banks undertook to hold a target level of reserves over any given month. If the average balance over the month was within 1% of the bank's chosen target, the bank was paid at bank rate. In times of uncertainty, banks may choose to hold greater reserve balances. It provides liquidity as necessary to banks. It attempts to ensure that there is always an adequate supply of liquidity to meet the legitimate demands of depositors in banks. It does this through the money markets. The financial crisis was incredible pressure on the aggregate liquidity on financial system. This meant thus that the usual mechanism for providing liquidity had to be adapted, and the end result was that the Bank of England, like many other central banks, supplied massive amounts of additional liquidity. It oversees the activities of banks and other financial institutions. The Bank of England requires all recognized banks to maintain adequate liquidity. This is called prudential control. In May 1997, the Bank of England ceased to be responsible for the detailed supervision of banks' activities. This responsibility passed to the Financial Services Authority, but the financial crisis of the late 2000s raised concerns about whether the Financial Services Authority, the Bank of England, and the IHM Treasury were sufficient watchful of banks' liquidity and the risks of liquidity shortage. Some commentators argued that a much tighter form of prudential control needed to be imposed. Finally, it operates the government's monetary and exchange rate policy. The Bank of England's Monetary Policy Committee, MPC, sets bank rate at its monthly meetings. This 9-member committee consists of 4 experts appointed by the Chancellor of the Exchequer and 4 senior members of the Bank of England plus the governor in the chair. By careful management of the liquidity of the financial system, Bank of England aims to keep interest rates in line with the level decided by the MPC. It is able to do this through operations in the money markets. These are known as open market operations. Well, this is the end of this chapter. In the next chapter, we are going to talk about money markets and the supply of money. Thank you very much for your attention.